Where are all the Toronto buyers? I've talked about this before, how we've now moved out of a seller's market into what's called a more balanced market and even a buyer's market in some areas. But are the buyers buying? The numbers indicate no. So let's talk about why that might be. I hear from buyers all the time that they're either waiting for prices to come down or for interest rates to come down, or both, which won't really happen. But before we dive into it, I want you to put in the comments if you'd rather buy at a lower rate or a lower price. I'm really curious. I mean, this is what we've all been waiting for, is it not? Prices falling faster than they have in 15 months. So why aren't buyers buying? Inventory is up, but so are interest rates. The Bank of Canada has held rates for the last 2 times, but as outlined in this CBC article, this doesn't mean that there won't be any more increases this year. The Bank of Canada has decided to keep its benchmark interest rate steady at 5%, the second straight time the central bank has done so, and a sign it may be moving to the sidelines after raising the cost of borrowing 10 times since last year. The move was widely expected by economists and investors who follow the central bank after a slew of data points in recent months, from GDP to jobs to inflation itself, painted a picture of an economy that was slowing down. 8 times a year, the central bank meets to decide on where to set its benchmark rate, known as the target for the overnight rate, which impacts the rates that retail banks pay for short-term loans. All things being equal, the central bank raises its rates when it wants to slow down an overheated economy, and it cuts when it wants to stimulate borrowing, spending, and investment. After slashing its rate in the early days of the pandemic to keep the economy humming, in early 2022, the bank began to aggressively raise its rates in order to slay inflation, which has risen to its highest level in 40 years. From the bank's perspective, inflation seems to be heading in the right direction, but in its statement announcing its decision, the bank makes it clear it doesn't think the inflationary dragon has fully been slayed just yet. In Canada, there's growing evidence that the past interest rate increases are dampening economic activity and relieving price pressures, the bank said. Consumption has been subdued with softer demand for housing, durable goods, and many services. But it did leave the door open just a crack for another rate hike if necessary. Governing Council is concerned that the progress towards price stability is slow and inflationary risks have increased, and is prepared to raise the policy rate further if needed. So let's take a look at where rates are now. From conversations with people I have in the industry, open houses are being attended and showings are happening, but there's a difference in the buyer sentiment now. They've caught on that A, they can take their time a bit more and they don't have the same FOMO that has happened in the recent past, and B, they're being stress tested at a much higher rate, so now they're being forced to think a little harder about what they can actually afford to buy, or they've been pushed out of the affordability range altogether. Back in March and April, the Bank of Canada held rates 2 consecutive times, and then we saw a burst of activity, but now this time that they've done this recently, we haven't seen the same increase in activity. Now, if you don't know, when the Bank of Canada adjusts their overnight rate, it has a direct effect on variable rate mortgages, where the fixed rate sector follows the bond market. The 5-year bond yield was down significantly earlier in the year, but has been dramatically going up over the last while. It has just recently been dropping again, but in October, the market was reacting to these increased rates. This is due to a variety of factors, but for the sake of this video, you just need to know that back in March, April, May, you could have gotten a fixed rate mortgage for 4.5% to 5%, but currently they're at 6 to 6.5%, and with the stress test, people have to qualify at a much higher rate now. This has pushed some buyers out of the affordability range, like I said, and made others much more cautious. So this is definitely impacting the overall market, and we're not seeing the same increase in activity as earlier in the year. And so this is creating a rise in inventory, especially in the condo market, which for a lot of first-time home buyers would be the sector they'd be looking at. And something to note is that a large percentage, maybe even as high as 75% of the available condo listings are either listed as vacant or tenanted, meaning that they're likely being sold by investors who can no longer carry those costs. So this could spell real opportunity for ready and willing end-user buyers looking to get into that asset class. With the average condo price down 1.7% from September to $729,000 in Toronto and half a point down in the surrounding 905 area, this is the only asset class that we're seeing negative numbers other than semis in the 905 as well. Now, you won't find the same thing happening necessarily in the freehold detached and semi-detached properties, simply due to there being less investors in these types of homes rather than that sell-off we're seeing in the condo market. And despite the headlines of prices drastically falling, detached homes are up 8% from last month to just over 1.7 million in Toronto and 4.7% up in the 905 to 1.35 million. Semis and townhomes are seeing less movement as prices there remain relatively flat. Now, what this headline is referring to is the benchmark price, which represents a home with the most popular set of features, which is down $23,000 from $1.127 million in September to $1,103,600 in October. The average price can sometimes be skewed if there are any outliers that sold for really low or really high. However, this is a commonly used metric. All of these numbers need to be taken with a grain of salt as they're giving averages for a large area, and your particular area and asset class that you're looking at may have its own nuances to consider. Now, the months of inventory, which tells you how long it would take for all the houses to sell if no others came onto the market, went up from 2.2 to 2.4. This is an indicator of the increased inventory I mentioned, as well as a slowing demand for homes from buyers who are waiting on the sidelines. Also, the sales to list price ratio dropped to 99%, which means on average homes are selling for 99% of the asking price, a drastic difference from the not long ago where everything was selling for over asking. And then you have headlines like this Toronto Star article, which states that buyers of new homes are walking away from deposits of up to $320,000. This is mainly from people who put down money a few years ago for a pre-construction and now find themselves unable to obtain financing or to close with current rates. Also, while this is happening, appraisals of homes are coming in at much less than they would have previously. So, prices of homes have come down. Interest rates are holding steady for now. So I'm curious, if you're a buyer, are you waiting, hoping that the continued rate increases will have further downward pressure on prices? Are you jumping in now that things seem to have somewhat cooled? Or are you over it and you're just going to rent, keeping in mind that rents are one of those things that have continued to increase as well? I am really curious to hear people's answers. Leave them in the comments below, and if there's anything I can do to help in your journey, please don't hesitate to book a call with me using the link below, and I look forward to chatting. Till then, stay well and stay hungry.